Today we are recording the third episode of the Baird Retirement Management Show. We are joined again by Scott Bartosh and Greg Ashcroft from the Ashcroft Pesek Bartosh Group. Scott is a certified financial planner and is a director with the Ashcroft Pesek Bartosh Group. Scott has worked as a financial advisor for over a decade. Greg is a chartered financial analyst, a certified financial planner, and is a senior vice president with the Ashcroft Pesek Bartosh Group. Greg has worked in the industry for 9 years. Today we are discussing Roth conversions in retirement. To get us started, Scott, can you give us more information on the types of retirement accounts most people have access to?
So we're going to go into Roth conversions today, but to give you just a little bit of background before we do that, I wanted to talk a little bit about some of the plans that most people are going to have access to. So if you are working at a larger company, one of the things that you probably can do and you've been prompted to do is contribute to a 401k. Some people are going to have both traditional and Roth options within a traditional contribution. The benefit of that typically is that you will get a tax deduction at the time you make the contribution. That money can then grow tax deferred within the 401k. And then in the future, you pay taxes when you actually distribute it and use it. With a Roth account, the benefit is that you will pay taxes on that money today. So you don't get that upfront deduction, but the money can grow tax-free for 20, 30, maybe even 40 years. And then sometime in the future, you can take it out and not have to pay any tax on that growth over a very long period of time. So that's the general difference between those types of accounts. Where we get to IRAs for the most part is either taking money out of a 401k through a rollover or contributing over the course of several years. $7,000 is the current maximum for people under 50 from your earned income to one of these plans. So with that being said, Greg, I think you were going to kind of open up the discussion on maybe some additional provisions within the conversion process.
Right. So I think many of our listeners might be wondering, what is a Roth conversion? How is it done? Who can do it? Are there any limitations to the amount that I can convert? And then obviously we're going to get into some of the questions regarding what are the upfront costs to doing a Roth conversion and what are the longer term perceived benefits of doing a Roth conversion. A Roth conversion, and I'm going to be speaking strictly when, in this case, talking about people who have money in their traditional IRA. And for Scott and I, this has almost exclusively talking to retirees who have rolled money over from a separate qualified plan. Scott got into the 401ks. Some people can also roll lump sum pension benefits into an IRA. But these are people who have retired. They've rolled the majority of their assets into a traditional IRA. And then now they're coming to us and they're wondering, would it benefit them to convert some of those assets into a Roth? So the mechanics of that conversion are fairly straightforward. If you have some money in a traditional IRA and you wish to convert that to a Roth, you can do what's called a trustee-to-trustee transfer or a rollover, and that is just taking money directly from your traditional IRA and moving it into a Roth. Now, the way that the IRS is going to view that conversion is going to be very much like W-2 income or ordinary income. So you're still going to be subject to ordinary income tax rates on the conversion, and you're going to have to pay that in the year that you complete the conversion, okay? Those conversions prior to 2010 were not available to high-income earners. And what I mean by that is you were not allowed to participate in this Roth conversion if you made too much money. So these things were subject to an AGI phase-out. That is no longer the case. Post-2010, income earners of all levels are allowed to do a Roth conversion. The second thing that a lot of people wonder is, okay, I know from my past experience that I could only contribute so much money to a traditional IRA. In 2024, that's $7,000 or $8,000 if you're over 50. Conversions are not subject to those annual limitations. So don't have to have earned income to do a conversion. You can convert as much money as you want in any given year. You can make as much money in any given year as you please and still convert to a Roth IRA. But there are some immediate costs to doing so. So Scott.
So Greg, just to interrupt quickly. So really, if you're wanting to get a lot of money into a Roth IRA, the way you're going to do that is probably conversion as opposed to contribution.
Yeah. So when you see monster Roth IRA balances, that tells you that a large conversion or a series of large conversions was done over time. It's very difficult to accumulate a vast sum in a Roth IRA by just making a standard contribution over the course of your career. It's not impossible with really great investment results to have a couple $1 million in a Roth IRA, say at the end of a good career, but if you're looking at the cases where we see now very large balances in Roth IRAs, those have been the result of a conversion.
Okay. So what is the downside, in your opinion, to having, it's a little funny to say this, too much money in a traditional IRA?
The downsides of having too much money in a traditional IRA, one, I think the thing people are most concerned with in retirement specifically is the required minimum distribution. So Roth IRA assets, and this was not something I mentioned previously, probably should have, they are not subject to required minimum distributions. And what this will afford a retiree is far more tax control beyond the age of 73, or for those born in the year of 1960 or later, 75.
Okay. So the reason I bring that up is I think we want to establish the basis for why in popular media, there's a lot of people suggesting that you should do these systematic Roth conversions. And I bring it up, again, as I said, because one of the things I think most retirees need to recognize is that some income from something like a 401k or an IRA in retirement is not a bad thing. You know, I think we can kind of be told or thought, well, I want to have everything tax-free in retirement. A lot of times it's just not feasible. And the reason for that is the mechanism that Greg talked about for getting money into Roth can be very punitive, where maybe you're having to expose a couple $100,000 or even more than that from a qualified balance to get money into that Roth. Would you like to expand on that a little bit more, Greg?
Yeah, and I think that you're right. I think in our business in particular, and this is not to question the motivations of any other advisor. I think the putative position for most advisors is once you've reached age 59 and a half and you have access to money in a traditional IRA and you can take distributions from that without having to pay any penalties and you don't have other sources of earned income, it makes Roth conversions look extremely attractive from a tax standpoint. And what I mean by that is you can now essentially take ordinary income distributions to convert them at tax rates that were not previously available to you. So for high-income earners, when they retire, they may go from a situation where they were constantly, or at least at the peak of their career, they were paying as high as 37% marginally on their income. They may find themselves in a position where they can cap out at 22 or 24% on a conversion. And so clearly that says the position seems to me have developed is, why would we not do this? And I think, honestly, Scott and I have a little bit of a contrarian view on this, which is we want to be clear as to where the benefits of a Roth conversion rest and to whom those benefits are going to ultimately accrue. The conversation we have with many of our clients is you have this large traditional IRA balance that you've built up over the course of your career. You feel like you should be converting some of this to Roth. And we ask them, why is it that you want to convert that money to Roth? And many of them are not distracted, but their focus rests on, well, I can convert at low rates today, and I can perhaps then benefit from converting at those low rates at some kind of foggy point in the future. So what our job is to provide clarity as to, or to demystify that future date. And for most of our clients, that future date is a date that will come for their heirs. So when we recontextualize the conversation and point out to our clients that it would be fine to do this conversion so long as you're doing it understanding to whom is going to really benefit, it can change the calculus for them some. And I think it is our job to clarify that for them.
I think another part of why people are counseled to and why they're motivated to make Roth conversions is fear. And the biggest fear is that tax rates are going to go way higher, not a little bit higher, but 50, 60%. I feel like it is something that's brought to my attention when people talk about this. And while I understand that, I think we want to look at the last couple times the tax code has been adjusted. How big has the change to, say, middle income and higher income taxes been? Maybe 2%, 3%. So, I mean, we're not talking about massive changes here. I think most people would think that whether, last time we talked about the tax code sunset potential, whether it sunsets or whether we get something new, I don't think that we're going to have a 50% top tax rate in a couple of years.
No, and I think that if we go back to 2010, when we were under the previous tax regime at that time, these were the same points were being made, which was high-income earners now have access to Roth conversions after 2010. Go ahead and do this because tax rates are at historic lows. They're always at historic lows, it feels like. It always feels like the doom exists somewhere in the future, and we should be taking advantage of tax rates today because once they're gone, they're gone. That's true. But then in 2017, we got the Tax Cuts and Jobs Act, and for many individuals, their income tax rates declined. And I am not convinced, and I know that you are not convinced, of this thesis. I do not think that tax rates are going to have to go up considerably in order to address the debt. And part of the reason for that is the only thing that the government can use to satisfy the debt are the revenues they collect. You can raise taxes in an effort to collect more revenues, but people change their behavior. So if you raise taxes considerably in the future, there will be people who will change their behavior such that, as we've seen tax code changes previously, if we look in history, the revenues to the government, they don't move very much with changes to the tax code. And I think that if you make significant changes, particularly to the voting bloc, and that tends to be people who are age 60 or 65 and older, if you're telling them, hey, you've accumulated all of your assets, and now at the point in time where you're going to need them for income the most, when you are retired, we're suddenly going to start taxing them at 50%, I imagine that such changes would be very unpopular.
And there's unintended consequences to any of these things, like you mentioned. Maybe tax rates go up dramatically and it causes a huge shift into some asset. Right now that's municipals, as an example, that isn't taxable. So, we create an asset bubble in one area, municipals in this hypothetical, and we create people dramatically wanting to sell out of, say, equities on the other side or taxable bonds on the other side. So there are unintended consequences.
Yeah, with any major legislative change, there's going to be second and third order effects that escape the analysis. And I don't think that this is necessarily a referendum on our congressmen and senators. I think that these things are just very difficult to model, and that often we're a little bit overconfident about particularly the long-run benefits of these legislative changes, and that's definitely been borne out with tax changes because people will demonstrate, like I said before, revenues to the government just have not really gone up no matter how punitive they make the tax rates.
Okay. So as much as everyone likes to talk about revenues to the government, let's talk about a scenario where you think Roth conversion would make a lot of sense. You kind of got into it a little bit earlier, but let's just lay that out. Just a hypothetical.
Yeah, and I don't want people to get the wrong idea to say that Roth conversions are unnecessary, or that our opinion on the matter is that Roth conversions are a needless, expense to a retiree under every condition. A prime condition, particularly for the group of people that we worked with, was 2020. So March of 2020, you had some assets or some stocks that were trading below their tangible book value. And what that means is the stock is priced below what the company could sell all of their assets for and satisfy their stockholders.
Is that good?
Generally not. So, it's good if you're a buyer, right? Or if you're in a position to convert those assets to Roth. So when you're given this sort of opportunity, and obviously in 2020, we sit here today with the extraordinary benefit of hindsight. This resolved itself, and it resolved itself in a manner that many people would never have predicted, which was
really fast.
Yeah, if you held on to your assets in 2020, or if you just bought the S&P 500 index as an example, January 1 of 2020, and you held it through December 31, you did about 20%.
Yep.
That was inconceivable in March of 2020. So not to get too far afield for how this pertains or why this is germane to the Roth discussion, if equities have a year like they did in 2020 or briefly in 2020, but say let's, as a more salient example, 2022, we got huge depression of asset prices. So you don't just have to do Roth conversions in cash, right? That's a mistake that people might make. You can convert a security. So you could say, hey, I own NVIDIA as an example, and it gets let's just say for whatever reason, it just loses a tremendous amount of value. It might behoove a person who owns that in their traditional IRA to say, you know what, let's find the silver lining here and let's convert an asset that I have faith will recover, and this is not a recommendation on NVIDIA, will recover considerably in the future. Can I transfer some of that growth to a tax-free environment and out of my taxable environment, and can I do so at a reasonable price?
Yes.
So in years where things get beat up, I think that considering a Roth conversion of assets in particular, that's a wonderful time to do it.
Okay. And my question was somewhat leading in that I wanted to kind of touch on depressed valuations. The other thing I wanted to bring up was, like I said before, somewhat surprising, but in retirement, you want some income. Mm-hmm. And so another scenario where I think Roth does make a lot of sense is, say you've retired, you haven't started Social Security yet, and you have literally no income. You know, you are just kind of living off money that's in the bank, so to speak.
Yeah, this is what I think people who are very pro-Roth conversion would call the Roth conversion sweet spot.
Yes.
Which is separation, no ordinary income, no taxable income. Maybe you haven't even started pension benefits or you don't have them. You're not collecting Social Security yet. You have extreme tax control in this environment. And so during that time, I think, yes, it's possible, particularly with how high the standard deduction is. There's a case to be made that you want to be creating enough income in order to really benefit from these deductions. This is especially true if you're an itemizer. So if you have a large mortgage, if you have, like in my case, a large mortgage and a bunch of children, if you are charitable, so if you're contributing to a charity and you're creating an itemized deduction that exceeds the standard, it definitely benefits you to create enough income against which you can take those deductions. So you're not going to get a tax credit for having been charitable. You can carry forward your deduction into future years, but it might make sense to say, all right, I have an annual gift that I'm going to make to my church no matter what. And for a lot of people, that's the case. If that fits you, you're going to want to create enough income from your traditional IRA against which you can take these deductions. And a Roth conversion can fill that slot in a very profitable way. So you can transfer some money out, pay very little income tax on it, and move that growth into a tax-free environment. So it definitely makes sense to at least enter retirement with some pre-tax assets if you're going to find yourself in that itemizer category, or if you need sufficient income to get the full benefit of the very high standard deduction.
Let's now transition to talk a little bit about situations where maybe it doesn't make that much sense to do a Roth conversion. I think the one that I see pretty frequently is, say you've retired, you have access now to do these Roth conversions, and you think, I don't want to have any RMD, which is a required minimum distribution, which depending on your age starts between 73 and 75. If it hasn't started for you yet, I want to move all of this to Roth. Let's talk a little bit about why that might not make sense. And you alluded to one of the reasons before, and I think this is a little bit tough to think about when you're, say, in your 60s, but one of the things that I see frequently is you move money to Roth, you fall in love with this idea of tax-free growth over a very long period of time, but you never touch it. Like you said, the benefit for most of the Roth IRAs that we work on is to that person's heirs. And if that's what you're trying to do, if that's your goal in a Roth conversion, let's talk about it. But I think it's important to recognize you may not spend money that you move to Roth. What do you think about that, Greg?
No, I think you're exactly right. I think that a lot of people have heard of King Midas because everything he touched turned to gold. But a lot of people haven't read that story through to its end, which is King Midas, he dies because he can't feed himself, because everything he touches turns to gold and you can't eat gold. With the Roth, it has a double-edged sword nature to it, which is exactly what you said. As soon as assets have been moved from a traditional IRA into a Roth, they are at the back of the line in terms of from where you're going to get your money in retirement. So you have after-tax assets, you have traditional IRA assets, and you have Roth assets. Once that money's in the Roth, it's quite clear to an outside observer, you want to leave that thing alone for as long as possible, because all of the benefit, and this is something we counsel our clients on, is on the growth. The principal amount that you convert, you have paid income taxes on that amount. That is essentially your tax paid basis in your Roth, okay? It does not do you any good to then go ahead and withdraw it if you're going to consume it, because you've just done you've done a whole unnecessary step between taking your money out of a traditional IRA and just spending it, all right? So now that you have this money in the Roth, it behooves you to leave it there as long as possible and consume all of your other assets prior to touching it. Now, there are some I would say not one-off cases, but there are some examples that we could point to where it's wise to have a little bit of tax diversity, as an example.
Yes.
And this becomes particularly true of people who have a fair bit of pre-tax assets. And if unfortunately one of the individuals in this couple passes away. So if an individual in a couple passes away, the surviving spouse not only has to contend with the grief of losing their spouse, but they're going to also be a single filer. And the tax rates and the progressive nature of the code, it's far harsher on a single filer than it is a married filing jointly. So if you have rather modest income needs and then you're a single filer and all of a sudden those income needs are going to be taxed very harshly, it might make sense in that case to take some of your income from the traditional IRA environment up to a predetermined threshold of taxation that you can live with or that we think is prudent, and then to interrupt the tax-free growth of the Roth in order to supplement your income in a tax-free way and not pay an ordinary income tax on it. So that might make sense.
I agree with you there, but the one caveat I would say is that in that scenario, if you had anything not in an IRA or a Roth, it got a step up in basis when the first spouse passed away.
Yep.
That, again, going back to that spending order, it's going to be above the Roth. So the Roth continues to be kind of like your Honus Wagner baseball card that's in mint condition. You're just never going to do anything with it. You're gonna leave it in the jewel case and not touch it forever in all likelihood.
That's exactly right. And we had a person come in, and I think that he was in the insurance business, and he was talking about some of the statistics regarding Roths in the first generation. And what he alluded to, and I can't cite the exact study that he was looking at, was something on the order of 90 or more % of first generation Roth IRAs never take a distribution. And what that means is, for the person who has worked to accumulate the capital, who has paid the taxes to get the money in the Roth, they never take a distribution that is tax-free in nature. And so that tells us that in most cases, the real benefits of that accumulation are going to go either to the surviving spouse, but even then, if there are other available assets, probably not, but to the children. And now, one thing that we should probably discuss is the new inherited IRA rules do make Roth conversions as an estate planning tool a little bit more attractive. And so the 10-year rule, which is the new rule that inheritors of IRAs are under, so if the deceased passed away, I think it was after the year 2020 or after the year 2020, and you've inherited a traditional IRA, you're facing a new set of rules. And there are two provisions that make these inherited IRAs very punitive to people who receive them. The first of which is the 10-year rule. So if you've inherited a traditional IRA, you have 10 years over which you're going to have to liquidate the entire account. Most recently, the IRS has provided some clarifying language on what's called the at least as rapidly as rule, which is a very long-winded way of saying if the person who passed away had already started taking their required minimum distributions, you will essentially have to carry that torch, and you will have an annual mandatory along with having that final mandatory distribution in the final year. So if we look at or if we examine where children are in their lives when they're traditionally inheriting these IRAs, and this was not by mistake, by the way, this is by design, these people are inheriting IRAs wherein they're very near their peak earnings years. So these are people who are, very generally speaking, in their 50s, maybe in their 60s, if their parents lived a very long time. And this is based on people generally start having children when they're 25 or older, as an example. So if you inherit a traditional IRA and you're in your peak earnings years, it's very likely that that traditional IRA is actually going to be taxed much more harshly in the second generation than it would have been in the first. And operating under those assumptions, you might then re-examine a Roth conversion and say, okay, if I'm looking down the road a little bit and my kids are really going to be subject to some onerous taxation, you might want to go ahead and convert those assets, because then over the life of the account, not necessarily the life of the account owner, you might have a lower effective tax rate.
So to recenter just a little bit, I think it's important to note that we are not saying you should never do a Roth conversion. What we are saying is that you should do it for the right reason and for the right person. And to expand on that just a little bit, if you are wanting to do a Roth because you think taxes are going to 50%, or you think you're going to get one over on the government, I don't think that's a great reason to be doing it. Also, if you are doing it because you think when you're 87 years old, you're going to take a big tax-free distribution from a Roth, that's probably not going to happen either. You're probably going to be watching TV and having a great time, but you're not going to need a huge Roth distribution.
That's right. And I think one of the lessons that we've learned in this business is that the IRS loves to change the rules of the game while the game is being played. And so from our perspective, high income earners having access to large conversions, that's relatively new. So that's fewer than 15 years ago. That's a very innovative piece of legislation as far as we're concerned. And the reason I bring that up is I have some severe reservations about whether or not the government will make good on that deal at all income levels or at all asset levels or all wealth levels. The primary example of this is Peter Thiel has $5 billion, that's billion with a B, in a Roth IRA. And I don't think he's yet 59 and a half, or if he is, he's just now getting there. And even so, he's got so much in terms of other assets. He's going to largely leave that for his heirs. And then under the 10-year rule, that's going to be dramatically less applicable to, his heirs.
But we're talking about tens of billions
We're
of
talking
dollars
about perhaps tens of billions of dollars that will escape, and the growth on all of that is going to escape income tax. So it wouldn't surprise me, and it wouldn't surprise us at all if, say, there's a bit of a threshold where beyond which they're going to institute something like a mandatory Roth distribution. So I wouldn't be surprised if, say, you accumulate $10 million, just as an example, just to make this a nice round number, and the government's deal with you is, all right, look, you don't have to pay tax on it, but you cannot continue to grow your Roth IRA beyond this predetermined amount. That wouldn't surprise me at all, because it's a way for them to get money out of that environment, to have it not continue to grow tax-free, and to get it back into assets that are going to grow subject to taxation every year.
They're basically saying you won the Roth game, but you can't play anymore.
Yeah, and does that strike me as entirely reasonable? I think, sure, but does it strike me as unprincipled to change the rules of the game while it's being played? Absolutely it does.
Well, and it goes back to, from our previous session, the estate tax does not make a lot of money for the government. So, does changing the Roth rules make a lot of money for the government? Probably not, but it would make money from the people that it's maybe politically correct to tax higher.
Right. Yeah. And I think the funny thing about the rule changes regarding Roths is the change was made to allow for conversions to raise revenues in the short run. Right? So the only reason they allowed high-income earners to convert money to a Roth to begin with was it would help balance the budget. They're saying we're going to do some government spending. We need to offset that with some revenues. If we allow higher income earners to now convert assets to a Roth, paying ordinary income taxes at fairly punitive rates on the front end, and there are some examples of people who did this right when it became available, and they paid an inordinate sum, well, maybe not an inordinate sum for them, but an inordinate sum from our perspective in tax to do so, that raised revenues to the government. But now that we're 15 years on,
we've balanced the budget, right?
It didn't balance the budget, but now being 15 years on, they're looking at some of these very large Roth balances and some of the extraordinary growth we got in the decade, say from starting 2011 through the end of 2021 in particular. They're looking at the growth that these assets are accumulating, knowing that they're never going to be subject to taxation, and they're thinking, wait a second, we might have put the cart before the horse here. And they do that all the time. So I don't think it would surprise us at all if there's a future cap on tax-free accruals in a Roth.
So to recap, Roth is an interesting option. It allows you to grow money tax-free for your entire life, for your spouse's life, and then for 10 years beyond that. When you can efficiently get money into that environment, it makes a lot of sense. But are there scenarios where you are pushing too much taxation into the present to get this kind of ambiguous future benefit? I think yes. Would you agree, Greg?
Oh, absolutely. I think our primary job is not necessarily throwing cold water on the Roth conversion itself. It is just putting the Roth conversion in its appropriate context and also reminding clients that there are some pretty strong tax benefits to other assets. And we alluded to this. Step-ups in cost basis on after-tax assets, creating enough income from a traditional IRA in order to get the full weight of your deductions. There are benefits to having some tax diversity, and a Roth IRA can definitely be a part of that. But again, our job is to enlighten clients on where the benefits of this are going to rest, and like Scott, you said, somewhat ambiguous and in the distant future, and to whom they are going to accrue. And in most instances, it is not the taxpayer.
And just as a final note, we'll probably go over this in a future session, but once you have that money in Roth, kind of an insidious part of the equation is it now behooves you for that to be your most aggressive asset. So you do these conversions, you now maybe are feeling pressure to be more aggressive, more risk sensitive in that type of an account. If you're concerned about, tax rates going up or there being a lot of volatility in the market, are you going to convert money to Roth and then put it in the appropriately aggressive growth-oriented instrument? Maybe not.
A lot of people don't have that appetite. And I think it's right to, as we close here, talk about some of the pitfalls in the mechanics. So one thing about conversions we didn't touch on was when you convert money from a traditional IRA to a Roth IRA, there is a 5-year period over which you cannot access the growth without paying a 10% penalty. You're not going to pay income taxes if you take some of the principal out, but that wouldn't make sense. The other element of this is if you do these annually or systematically, every single one of your conversions has its own 5-year clock attached to it. So it's not as if you've started an IRA or a Roth IRA and you've got that start date and now you just have to wait for 5 years as you would with a contribution. And now everything you put into the Roth is essentially tax-free, not subject to a 5-year rule. On a conversion, it's not the same. And this is one of the very few provisions in the tax code that transcends death. So if you made a deathbed Roth conversion, your heirs would still have to wait out that 5-year period. That's something that a lot of people don't know. The other thing some people don't know is if you're going to convert money from a traditional IRA to a Roth IRA, and you're going to do so prior to attaining the age of 59 and a half, you must have the liquidity outside of your traditional IRA from which you can pay the tax. The reason is if you make a withholding payment from your traditional IRA, that is considered a distribution. And if you are not 59 and a half, that distribution is now subject to that 10% penalty.
So you're going to pay tax and the penalty.
And a penalty. And this is something that a lot of people fail to consider. Finally, when you are examining the benefits of a Roth conversion, a lot of these assume that you have the capital outside of your Roth IRA or outside of your traditional IRA to pay the tax. And this is even if you're after the age of 59 and a half. And the reason that they do that is if you pay the tax from the conversion itself, one, you need to gross the distribution up by the amount of the tax in order to get the same value in the Roth, right? So if you wanted to get $1 million in a Roth, but you were going to do the withholding from that conversion itself, you'd have to distribute far more than, well, maybe not far more, but you'd have to gross it up for the taxes that would be due. And then, like I said, that withholding payment itself, if being made from the conversion itself, is also taxable. So these are some common misconceptions or common errors that people make when examining the Roth without the benefit of, decent tax planning. And again, it's our job to make sure that we contextualize the Roth, we identify these pitfalls for clients, and we make sure that you don't stumble on them as you're doing this.
Scott, Greg, thank you both for taking the time to walk us through this today. And to all those listening, thank you. To make sure you don't miss any future episodes, you can subscribe to the Baird Retirement Management Show wherever you get your podcasts. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.